Hey there. In January 2026, the Swiss franc hit its strongest level in years. At the exact same time, Switzerland's central bank interest rate was sitting at 0%, the lowest of any major economy on Earth. And on top of that, the US had just slapped a 39% tariff on Swiss exports, hurting entire industries overnight. By every normal rule of economics, the franc should have been sinking. Instead, people kept buying it. Switzerland has spent years trying to make its own currency weaker, and it keeps failing. So today, we're finding out why the world refuses to let the Swiss franc get weak, even when Switzerland is basically begging it to. Wait, hold on. If you watched my video on why currencies have different values, you already know most countries want a weaker currency, not a stronger one, because a weak currency makes exports cheaper. So why is Switzerland stuck with the opposite problem? Well, it comes down to one idea. Money has feelings. And right now, a lot of the world is scared. And scared money only wants to go to one place. So, in this video, we're going to break down why Switzerland became what traders basically treat as the world's panic room. What happened in 2015 that still makes currency traders nervous, why Switzerland's central bank does things almost no other central bank on Earth does, and why even a brutal tariff couldn't put a dent in this currency's strength. Let's get started. So, what makes a currency a safe haven? Think of it like this. When people feel unsafe, they want to put their money somewhere boring and predictable, kind of like stuffing cash under a mattress, except at the scale of an entire country. Switzerland has basically spent 200 years turning itself into that mattress. It hasn't been part of a war in centuries. Its government doesn't flip every few years. It doesn't carry much debt compared to its economy, and its institutions are famous for being, honestly, kind of boring. But boring is exactly what scared money wants, and you can actually track this pattern through history. In 2008, when the financial crisis hit, money rushed into francs. When the UK voted for Brexit in 2016, same thing. When COVID shut down the planet in 2020, same thing again. And in 2026, when conflict broke out in the Middle East, the franc climbed again, gaining against the euro as nervous investors looked for shelter. Every single time the world panics, somebody, somewhere, buys Swiss francs. That's why traders basically treat Switzerland like the world's panic room. But here's the thing about panic rooms. Even they have limits. Back in 2011, Switzerland made a promise. It told the world that it would defend a fixed exchange rate. 1 euro would never be allowed to fall below 1.20 francs. To make good on that promise, the Swiss National Bank said it would print unlimited francs if it had to, just to keep the currency from getting too strong. For over 3 years, that promise held. Then, on January 15, 2015, without any warning, the Swiss National Bank simply gave up. It dropped the promise completely, and the market broke. The franc jumped violently within minutes. Currency brokers lost fortunes overnight. Some of them went bankrupt on the spot. It's still talked about today as one of the most chaotic moments in modern currency trading. And here's the part that matters for our story. Ever since that day, traders learned something important. Switzerland can defend a line for a while, but eventually, if the pressure builds up enough, it lets go. Which means the market never really stopped testing that line. So, after 2015, Switzerland tried something different. It pushed interest rates into negative territory. Remember, a negative interest rate basically means you pay the bank to hold your own money. It's the complete opposite of normal saving. Why would a country do that on purpose? Simple. Switzerland was hoping that if holding francs became a losing deal, people would take their money elsewhere, and the currency would finally weaken. It didn't really work. People kept their francs anyway. Losing a small amount slowly still felt safer than risking everything somewhere else during a crisis. And that tells you everything about how strong this safe haven habit really is. Fast forward to today. As of June 2025, Switzerland's policy rate is back at 0% after 6 rate cuts in a row. 0. The lowest of any major economy in the world right now. And even that hasn't been enough to scare people away from the franc. So, if cheap money doesn't work, what's left? This is where things get a little unusual.
The Swiss National Bank has a tool most central banks barely use, called foreign exchange intervention. In simple terms, it prints francs and uses them to buy foreign currency, like euros or dollars, flooding the market with francs to push the price back down.
And Switzerland has the firepower to do this at a massive scale. As of January 2026, its foreign reserves were estimated at roughly 715 billion francs. That's an enormous stockpile for a country its size. Here's a fun detail most people don't know. The Swiss National Bank is actually one of the only central banks in the world where you can buy shares on the stock market. Its profits and losses move up and down almost like a giant investment fund, because a huge part of its balance sheet is foreign stocks and bonds. Switzerland's central bank isn't just managing money. In a way, it's also playing the market. Now, here's where 2025 threw Switzerland a real curveball. In August of that year, the United States imposed a 39% tariff on many Swiss exports. The Swiss National Bank's own chairman called it a major difficulty for Swiss companies. Watchmakers, machinery makers, and pharmaceutical exporters all felt the pain, and growth slowed down. If you're thinking, well, that should finally weaken the franc, right? A weaker economy usually means a weaker currency. That's the logical guess. But it didn't happen. Because here's the part that trips people up. Safe haven demand was never really about how well Switzerland's economy is doing. It's about how scared everyone else feels. Investors weren't buying francs because Switzerland was thriving. They were buying francs because everywhere else felt riskier by comparison. A tariff can hurt Swiss factories. It can't really touch that. So, a strong franc isn't purely good or purely bad. It depends who you ask. Exporters get squeezed. Their watches, machines, and medicines become more expensive overseas, and tourists find Switzerland pricier to visit. But regular Swiss citizens actually benefit in some ways. A strong currency means cheaper imports, and it helps keep inflation low. So while factories in Switzerland are complaining, the person buying groceries in Zurich is quietly getting a pretty good deal. So here's the real answer to our question. The Swiss franc doesn't stay strong because Switzerland's economy is unstoppable. It stays strong because the franc functions like a fear gauge for the entire world. Every time something scary happens somewhere else, some of that fear ends up parked in Swiss francs, whether Switzerland wants it or not. The Swiss National Bank can lean against that. It can cut rates to zero. It can flood the market with francs, but it can't fully erase the reason people trust it in the first place. You can turn off the lights in a panic room. People will still remember exactly where it is. So, in conclusion, Switzerland isn't struggling to weaken its currency because it's doing something wrong. It's struggling because the entire world quietly agreed over decades that Switzerland is the place to run to when things fall apart. And that kind of trust doesn't get erased by an interest rate cut or a tariff. If you haven't seen my video on why currencies have different values in the first place, that one pairs perfectly with this. Help us keep making videos like this by becoming a member and unlocking some exclusive perks too. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.